Hi, my name's Leon Rowe, currency trader and trading coach at trading180.com, and welcome to this week's supply and demand Forex, gold, and S&P fundamental and technical analysis for the week ahead, starting the 2nd of November. Hope you're all doing well and had a great trading week. So, getting into the week ahead, and this is from Trading Economics, and it says here the prolonged US government shutdown will likely delay a batch of major data releases, but private sector reports and key earning results will still unveil fresh insights on the US economy. These will be headlined by the ADP employment report, ISM PMIs, and the University of Michigan Consumer Sentiment Index. On the monetary policy front, rate decisions will be taken by the Bank of England and the Reserve Bank of Australia. Additionally, industrial sector data is awaited from Germany and Italy. Labour updates are due from Canada, and inflation prints will be released by Switzerland. So there is some market moving news, especially from the monetary policy front as well. So getting into the risk sentiment side of things first before we get into interest rates and yield differentials. And it's important to really understand why we look at risk on and risk off, and whether the market is in either risk on or risk off mode. And it's because investors will put money into and take money out of assets depending on their level of risk, whether it's they're more being defensive and trying to protect what they've got, or whether they're looking for a yield. And how that kind of works with currencies is that when we're in a more risk on, then the market is focused on yield differentials, meaning interest rate differentials and yield return. And when we're in a risk off mode, then money would typically tend to flow into safe haven currencies like the Swiss franc, the Japanese yen, and to a certain degree the US dollar. So looking at the top left-hand side chart, the VIX, the volatility index, is a measure of volatility, but also whether risk is on or off. And the higher the VIX, the more intense, I guess, the risk off sentiment. And the lower we are, below 20, is the more we're looking at bit more yield return. And so you can see from the volatility index, we are around these 17 and a half, which is more risk on, and that's kind of confirmed with the stock market, which is seen again as a risk on asset, meaning that investors are looking for more of a return and want to take more risk in the market. And so that kind of confirms that we are in risk on environment. We've seen gold pull back over the last maybe around about a couple of weeks or so. We've reached the highs of $4,381, and now we're around the 4,000 mark. This is due to probably more risk on sentiment, but also as well the fact that the dollar has strengthened a little bit recently, and we'll get into that a little bit later. And also as well, bond yields, especially the 2-year and the 10-year, are indications of interest rate expectations. And you can see here the US 2-year Treasury yield popped up on Wednesday on the FOMC meeting, and that was due to a bit of a hawkish Fed. And again, we'll talk about that a bit later. So when it comes to risk sentiment, though, we can see really that risk is more on than off as well. Looking at the headlines and the front pages of the main news publications, there's no real central theme when it comes to any kind of risk off sentiment or events. In terms of the markets, it's talking about stock bulls power S&P 500's historic winning run, and there's really nothing here that's kind of generating any kind of fear, uncertainty, or doubt. And then we've got the front page of the Financial Times, says here US stocks ride AI hype and trade truce to 6-month winning streak. So again, nothing really about, for example, a risk off event would be, maybe some sort of trade deal not going right with China and the US. But again, that's not really front pages anymore. And we've got with Reuters, it has here markets exclusive: Turkey buys more Russian oil after latest Western sanctions. But really nothing that would cause, I think, investors to want to be more defensive, right? This is just everyday news, and I guess the news is here to sell the news, but what you want to see is really a central theme. So, as an example, if the market was focused on a bit more risk off sentiment, you would normally see the headlines would all be kind of in sync with whatever that risk off headline is. So, at the moment, we're in risk on mode. So, looking at the central bank policy and upcoming meetings and what's really happening when it comes to interest rates, cuts, holds, and hikes. And really, the idea is to buy the currencies that are where the central bank is looking to, hike or hold versus the ones that are looking to cut, because a central bank that is cutting rates is actually trying to devalue their currency. A central bank that is holding rates is actually, satisfied with the value of their currency, and a central bank that is looking to hike rates wants to appreciate their currency to fight inflation. So that's the baseline. Now, it's not necessarily as simple as that. There are lots of nuances that go into this, but that's really the idea. So what we're going to focus on, as we do every week, is really the main currencies. So, for example, the US dollar, for example, the Fed. We're focused on the Bank of England, the Bank of Japan, and the ECB. So that covers the pound, the yen, and the euro. So when we're looking at the Fed at the moment, it looks like they are looking to cut rates, but this actually, the probability of a change has been reduced now to 66% chance of a cut. And when we go to the Fed Watch tool, we can see that the dollar has actually rallied this week, and we'll go to the chart in a sec. But you can see last week we had the market was pricing in a 91% chance of a cut. And now this week, from the end of the week on Friday, it's now 63% chance of a cut. So the market's pricing out cuts, meaning that they're not too sure whether, or they're less sure whether the central bank wants to cut rates and basically devalue their currency, right? And so when we look at the reasons why, and we go to the United States channel, 1 second, let me just go here. Go to United States Discord group. And by the way, if you do want to get involved and join the Trading 180 mentoring group, we are open. Enrollment starts on the 3rd of November, and it's going to be for a limited time. I'll probably be open for maybe 3-4 days. It'll be the last intake of people that I will take this year. So if you've been waiting patiently to join, then we will be opening on the 3rd of November, and it'll be the last time this year that I will be accepting an intake of people to really kind of get them up to speed with the fundamentals, so you can apply it to your trading and really understand how the market works. And also as well, if you are in the group but you're watching this video, we have the more detailed video. I've announced it in the Discord group, but we've got a training videos channel. This is a members only area, and I've uploaded the 1st of November weekly analysis, which goes into all of the currencies, all the pairs that I'm trading, etc., as well as the previous weeks, months, and years videos, where you can go back and see all the trades that have been taken, all the analysis and everything here. I think I've probably got maybe around about 5, 6, 7 years of videos in here. So that's where we are. And again, just a quick reminder again, just that the enrollment will only be open for a few days, maybe until Wednesday or Thursday. So again, it'll be the last time I will be accepting traders into the members area. So sign up if you want to. If not, no worries. Keep watching the free videos, and hopefully you gain from that. So going back to the Federal Reserve, and in fact the Discord channel. So the Fed actually cut rates on the 29th of October. So they cut to 3.75% from 4%, so down 25 basis points. And Powell's key comments was that there's no guarantee of a December cut. So it says here, a further reduction in policy rate at December's meeting is not a foregone conclusion. Far from it, in quotations, acknowledged growing divergence within the committee, signaling that the ongoing government shutdown has disrupted access to data, which is likely slowing decision making as well, right? So it says here, market reaction and expectations. The pre-meeting, it had 90% priced in for another cut in December, and then post Powell obviously dropped to 60% per interest rate swaps, which we just kind of looked at here, right? So yields and the dollar jumped, so equities dipped, and the reaction to Powell's hawkish tone and the latest CME FedWatch probabilities also show shifting expectations for December and beyond. And again, December cut is still on the table, but not guaranteed. But the overall takeaway was that this was a hawkish cut. So the Fed eased policy again, but is not on autopilot towards further cuts. Powell's messaging is calibrated to contain market optimism and buy time amid data uncertainty and internal policy disagreement. So when we look at the dollar index, the equally weighted dollar index, we see from Wednesday we did get the market start to price out the rate cuts, but it doesn't necessarily mean that they're going to be fully priced out. We are waiting for the data, but I think the dollar could be in the short term a little bit of a buy. But just remember that ultimately, once the market decides on which way the interest rates are likely to go, it could prices could or the probability could start to rise, and if it does start to rise, then you're likely to see the US dollar move to the downside. So if the market starts to price out the rate cuts and the probability goes down for a rate cut and up for a rate hold, then you're likely to see actually the dollar start to rise. But again, this is all dependent upon inflation and interest rate, and GDP data, right? Labor data, employment data. So the dollar, I think at the moment in the short term, there are reasons to buy the dollar, but I still think overall the dollar is a sell, whether it's going to be here or slightly higher. I do think the dollar is likely to probably be contained within this range about this high here, where we've got some support and resistance in confluence with this supply zone. So this week it drifts higher. I'm still looking for really sells, because ultimately 63% of a rate cut is still a high probability of a rate cut, right? If you had a coin flip, you would definitely want to take that coin flip if it was weighted 63% in your favor. So the dollar for me is still a sell. The euro, looking at this, the equally weighted index, it has pulled back a bit now. I do think the euro is still in a better position than the dollar, and that is due to really rate holds. So the central bank really is satisfied with where the euro is at the moment. 94% chance of a hold at their December 18th meeting. Now again, that is subject to change dependent upon inflation data and GDP data, but currently when we look at what the European Central Bank are saying about interest rates, they are saying that inflation is easing but still above target. Core inflation, excluding energy and food, at 2.4%, unchanged, signaling persistent underlying price pressures, especially in services. 3.4% interpretation, while headline inflation is near target. Core inflation shows that underlying pressures remain sticky. Christine Lagarde said policy is in a good place, meaning the ECB believes its stance is appropriately restrictive to bring inflation sustainably to target. The ECB is waiting for clearer disinflation evidence before cutting rates. Growth remains modest but resilient. So in short, it says here, inflation is close to target, but not convincingly stable there yet. Growth is soft, but not collapsing. The ECB is cautious, keeping policy tight enough to anchor inflation expectations while monitoring how trade disruptions and global shifts play out. So for now, the European Central Bank ultimately is content and satisfied with where the value of the euro being where it is. It's meeting its inflation targets, and the economy is fairly balanced. So for me, when you've got one central bank who are cutting rates and another who are holding rates, you want to go with the one that are holding rates. And so any pullbacks, I think, should be seen as probably buying opportunities, likely buying opportunities. Where it turns around, who knows? But ultimately, when you get a reversal signal, technically, that's where I would look to buy. Not giving you financial advice, of course, but this is what I'm looking to do. Any pullbacks, I'm looking to buy on the euro, unless, of course, data supports otherwise, or the data kind of changes. So for me, euro remains more on the buy side than the sell side for now. Looking at the yen, and the yen did have a bit of a move to the upside on Tuesday, and then when we had the Bank of Japan meeting, we did get a move to the downside. There was a little bit of dovishness at first, but inflation data has come out in Japan, which really kind of supports um, a rate hike from the Bank of Japan. The problem is, though, with the Bank of Japan and the Japanese yen, is just the politics side of things, where the new prime minister is seen as being a bit more counter. Their fiscal policies are a bit more counter to the Bank of Japan's. But it says here, Tokyo inflation accelerates. Overall CPI was at 2.8%. The main driver was expiry of city water subsidies, which had previously pulled prices down sharply. And Tokyo CPI often serves as a leading indicator for national inflation. The uptick suggests nationwide inflation may stay above the Bank of Japan's 2% target longer than expected. And Governor Ueda continues to argue that underlying inflation momentum is not yet sustainable enough for rapid tightening. The central bank is likely to raise rates gradually, if at all, preferring caution amid global trade risks. And it says the bottom line here is that higher than forecast signaling persistence above target is inflation. Policy stance cautious, tightening bias, but no rush. The economy is fragile balance, moderate growth, stable jobs, but weak consumption. And again, slightly stronger, but long-term depreciation pressures persist unless rate differentials narrow. So rate differentials being, of course, the Bank of Japan get a bit more hawkish, and so at the moment, kind of a neutral to hawkish central bank is really what is needed for prices to move to the upside. Now, I do think that the data is supporting hikes, gradual hikes. So I don't know how far really how much more the yen should appreciate. Hopefully this would be a reversal, as I am in the New Zealand yen trade, buy low, sell high kind of thing. And I'm buying the yen around this area here, hoping that we get some more upside. I do think the yen is a cautious buy because the central bank policy, of course, should be really to hike, and there's a 69% chance of a hike at the moment. So let's see what happens with the yen. But if you are buying the yen, I think now is definitely an opportune time. And the pound. At the moment, the pound had a bit of a depreciation on the Tuesday, and that was really kind of due to, I think it was some inflation data, or was it jobs? Which one was it again? It was, one second. It was inflation was cooling basically, and it says here surprise rate cut risks grows. So the market is now traders actually expect no change, right? But Barclays and other banks are thinking that there may be actually a surprise move. And it says here, Barclays Bank, their base case is for a cut, and Goldman Sachs also forecast a cut, which aligns with Barclays' view. But most other analysts expect to hold, citing still high inflation. So when inflation is high, normally a central bank would either hold or hike rates, but the argument for really kind of cutting rates is that in September CPI came in below expectations. Labor market, there's signs of softening, and support is preemptive easing, and that the Bank of England governor says that UK is running under potential, and that refers to GDP. And really, the pound is lower since and been lowest since against the euro versus since 2023, and fallen to 9 months straight lows. So for me, the main reason why we want to get short, and I've been saying to short the pound, is because of the uncertainty around the budget. There are arguments for holding rates as well, and again, inflation is still kind of 2 times above the Bank of England's inflation target. But the key takeaway is that Barclays, Goldman Sachs, and Nomura believe markets are underpricing the risk of a cut next week. If the Bank of England does surprise cut, it will definitely surprise markets, triggering a pound sell-off and boost UK bonds. And the 5-4 Monetary Policy Committee split vote would highlight deep policy division and signal a dovish pivot is already underway. So, I've been, as you guys, anyone who's been following me for a while, I've been saying pretty much, you can look at the last few weeks videos, actually the last few months videos, I've been saying to kind of look for shorts as prices move to the upside, and eventually we got the pound rollover. So that's not really changed. Any pullbacks to probably the underside of a level, which may be around here, I think would be a definite short for me, or shorting opportunity in terms of the pound. So going back and just recapping, for me, the pound is a sell. If you do want to be a buyer, though, you'd have to wait for the pound to kind of pull back into a demand zone before going long. The euro is more of a buy, and so we've pulled back here. So I think the euro should be more of a buy. The yen is more on the buy side as well, and the pound is on the sell side. So now when we look at the pairs like the euro dollar, it's easier to now see where you should be looking to buy or sell, whether you should kind of just stay out of the currency, and whether it's clear or not. Now, for me, the euro dollar, I think, is still likely a buy. I think the dollar is obviously a bit on the expensive side. The euro is on the cheaper side. So I think actually there could be a nice opportunity to buy in and around this area. We do have a supply zone that kind of starts from here. I'll drag that down a bit. So if you do want to be a seller of the euro dollar, which means that you're buying the dollar over the euro, then you'd be looking for the 116 area as an area to look for shorts at bare minimum. When you zoom down into the lower time frames, you can see the monthly highs are around this 117.80. We are at monthly lows. This looks like a really nice stop hunt trade. So I'm going to probably take a small position if this does set up to be a stop hunt, and I'll look for some longs on this. But very, very nice when it comes to a technical setup. Looking at the dollar yen, so the dollar yen, not really a pair that I'm interested in at the moment because of the hawkish cut, and we've seen that kind of play out in the market to the upside. So I think any pullbacks on the dollar yen, if you want to be a buyer of the dollar, I think is actually quite nice. Technically, though, I would say the yen is probably you want to probably look for short trades, but fundamentally I think there are definitely better trades out there. A hawkish Fed and a I guess you could kind of say a more neutral to hawkish Bank of Japan makes it a little bit more difficult to kind of read in the short term. So you could look for shorts here, you could look for longs here, but ultimately I'm kind of staying out of this pair as it's not necessarily as clear as many other pairs. The pound dollar, I think in the short term, the dollar definitely has the advantage. You've got a bit more of a dovish or perceived dovish Bank of England, and a bit more of a hawkish Federal Reserve. So when you zoom in, you can look for, if you do get a pullback and you want to be a buyer of the dollar, I think that is going to be a really nice technical level to look for any kind of sells. But again, with this pair, not really, or I guess you could look for a trade on here, but you would have to really kind of bet that the pound is going to be the weaker of the two. Again, I think there are better pairs out here, but you can look for either buys if the data does support rate holds for the pound, but if not, if prices just start to move back with bad news for the pound, then you can look for probably sells here on the pound dollar. to buy the dollar, euro, pound. I'm still in this trade. We'll go over this in the trade updates at the end of the video. But yeah, we're saying I am long in this, so trailed my stop up, and so we're seeing really this move with the euro again. Interest rate differentials, right? You've got a central bank that are looking to hold rates, whereas the market is pricing in cuts, potential earlier cuts for the pound, and you're seeing that play out in the market as prices go to the upside. So if you are looking for a buy on this pair, then you would look for a move back down into this demand zone before looking at buying to go long, and hope that the data supports rate cuts for the pound and rate holds for the euro. And the euro yen, again, both central banks I think are a bit more on the buy side in terms of currencies. So again, a difficult pair. Really what you want to do is look for clear divergences. I don't think the divergence is clear on the euro yen, so I'm not necessarily in this, but or looking to trade this. But technically you've got a level there if you want to be a buyer of the euro. If you want to be a seller of the euro and buy the yen, I don't think you've really got anything to look for any kind of sells. I would probably say this might actually look like a stop hunt on the lower time frames. If you go down to the lower time frames here, yeah, actually that looks like a really nice stop hunt. It probably just played out. So if you do get a pullback into this area here, I think that can be a nice sell trade. But again, for me, that's decent technically, but just not from a fundamental perspective. So I'm staying out of this trade. But if you do want to look for a sell trade, then you'd have to wait for a pullback before going short. And then you've got the pound yen, which for me, I was saying I would rather get short on this. But things just didn't align for me from a buying the pound at a cheap area. So whenever I'm looking for a trade, and this actually turned out to be a really nice stop hunt trade, I was saying to the guys in the group, the stop hunt happened around here. But at the time that this was happening, the pound, if you look at the pound index, it was actually on the expensive side. So let me just go back to the pound yen. So it was a Friday the 24th of October around here into Monday, right? And what you want to do really is look for the pound to be on the expensive side, not the cheap side. But you can see here the pound was already at lows, and you never really want to sell the pound at lows or buy at highs. That's just my rule anyway. Some traders do, they buy breakouts and sell breakouts, but to the downside. But for this trade to really be a trade for me, I would have needed the pound overall pound index to be somewhere up here on the day, and then look for a short. So it'd have to be in that supply zone before looking for a trade. So the yen was already on the cheap side last week. You can see, last week Friday or around the Monday here, it was a buy trade around there. But ultimately, the pair overall, although nice, just didn't align with my strategy when I'm looking to buy and sell currencies. But the trade did work out. But if we can get back somewhere up to these areas here, and then the pound becomes expensive, the yen remains on the cheaper side, I think this is going to be a very, very nice trade to the downside. Looking at the precious metals overall, now with a hawkish Federal Reserve, gold and silver are likely to come under pressure. So yeah, I think overall gold should still remain more of a buy, though. Again, the Fed are still likely to continue cutting rates. So if you do get a pullback into that zone, that's a decent area to look for a long trade, as long as the data supports it. If you are looking for sells on gold, then you have to wait for prices to pull back up to this area here before looking at a short. Same thing with silver. Silver's in the same boat. You've got a supply zone right here. And then you've also got a demand zone around here. So you can look for some buy trades if prices pull back to these lows right here. and look for some upside. Looking at this from a monthly perspective, this is the monthly lows here, so that level's been touched once, twice. In fact, that was a really nice intraday stop hunt last week right there. Prices moved to the upside, so I think in fact that does turn into a bit of a CPR, capture pain relief, for those of you who are in the group. Nice capture pain relief setup right here, so if prices do pull back to that area there, that is going to be nice. You also have a stop hunt level around these highs here, so if you do get a stop hunt above that area and the and you want to be a short on the on silver and buy the dollar, let's say for example the Fed come out and they're really hawkish and the market starts to price out rate cuts, then I think that's going to be a very nice level as well to look for some short trades. Moving to the S&P, and the S&P has pulled back a bit based on, I guess, the rate cuts being priced out a little bit. Stock markets typically tend to move in alignment overall over the medium to long term, in alignment with rate cut expectations or rate hike expectations. I do think that we're probably likely to get a bit more of a move to the upside. Any pullbacks, that gap probably needs to be completed. The unfair auction needs to be completed. So if you do get prices move back down into here, that could be a decent move. But I would think for me, any moves down to the 740s and below would be more of a trade. When we're looking at that as a percentage in terms of a pullback, it's not necessarily much. I do like to have at least maybe about a 3 to 5% pullback on the stock market if you can. So bare minimum I would look for at least is around this. Again, 3% pullback would be maybe the 672s. So let's see what happens with that. But again, unless the Fed start to really get hawkish and the market price out any more rate cuts, then you're likely to see prices, even if they pull back and break that trend line, continue to move to the upside. New trades. So a trade that I am in this week is the New Zealand yen. Fundamentally, the New Zealand dollar, they are looking to cut rates. You can see here the New Zealand dollar, 86% chance of a rate cut. And also as well, a little bit more analysis. It says here, market strongly expects a cut to 2.25%, reflecting a dovish shift due to weak data, 86% chance of easing. So that's the RBNZ right here. In fact, just so that you can see where I am right there. And then we've got the Bank of Japan, only central bank with a hike priced in. Markets see about a 69% chance of a move to 0.6%, reflecting inflation resilience and yen pressures. So two diverging central banks at the moment. And so this is an area that I was looking for a sell. We were talking about this, in fact, in the group. I made a video about it. If you are in the group, then it would have been the, one second, let's go back. Let's go back to today's current date. So you can see here, New Zealand yen, did a trade analysis on that there for the members. So we managed to get involved in this. Zooming down, my entry was around here. Now I'm only in one position. What I normally do is I look to enter 3 positions or 4 positions, one at 50% and then one at about a 95% pullback. So if prices do pull back, which many times they do, then I'll get in at a better price and have a better risk reward, right? So but for now I'm only in one position, and so the trade is actually going quite nicely. And so if we continue to get a dovish New Zealand central bank and a bit more of a hawkish Bank of Japan, hopefully we can get a bit more moves to the downside. So that's what I am in at the moment. The setup itself was a nice stop hunt above the market around here. Very nice. And then move to the downside. Now, trade updates. I'm out of the pound CAD. Pound CAD, pretty much the stop hunt was just like the setup was just like the New Zealand yen, where you had a level here, nice stop hunt above here. Again, you can, if you go back to my previous videos, I go through the trade analysis, and we entered here. Only managed to get in on one position though. I was really close to getting in on 2 positions. You can see prices pulled back, but didn't quite fill that position there. but then we ended up, moving to the downside. I took about 80% profit off and then managed to trail my stop down and ended up taking profit. I think it was around here during our weekly Zoom call videos that we have on a Wednesday, live group calls. Was saying to the guys that I was looking to take profit. So I ended up taking profits somewhere around here, somewhere around these lows. His prices had kind of created these unfair auctions, kind of moved a bit parabolic. So ultimately, when prices tend to move like that, then you will get a pullback. So I thought I'd just take the rest of the profit. So really got in up here, managed to take profit down here. Really nice, a good few hundred pips profit on that one. And then the euro pound, I'm still in this trade. I've trailed my stop up to around here. My original entry, again, you can go back to where I got in. I think it was around the 8th of October. Managed to take profit, 80% profit off that one position here. And then I'm just basically trading up the 20% on this, been holding it for a while, and as we see prices have moved to the upside, if prices continue moving to the upside, then I will continue to kind of just trail my stop up around here. So my stop at the moment is at the 87 round number, and if it makes new highs, then I'll just trail up there and just keep trailing up until I get tagged. But this again is a profitable trade on the pound CAD. Really nice trade that, and then hopefully the new trade, the New Zealand CAD trade, will be profitable as well. So that's where I am with my trading. And again, just a quick reminder that if you are looking to enroll on the 3rd of November, is going to be when you get the opportunity. And again, we only open for a limited time, maybe 3 or 4 days, and then that's going to be it for the rest of the year. So that'll be your last opportunity for 2025. If I do work with you, I look forward to working with you. If not, I wish you all the best for the rest of 2025 into 2026. So take care, guys. All the best, and I'll see you in the next video.